Okay guys, now we're going to take a look at the same problem but from the buyer's perspective. So remember, as the buyer or a big company here in this example, transactions are going to look differently. It's the exact same transactions, but when we were the seller, we would record the transactions in one way because it impacts us in one way, and it's going to impact the buyer differently. So for this first example here, we can see, and we remember this from the previous video, we made a purchase of $72,000. The shipping terms were FOB destination, which means it became property of ours once it arrived at its destination. We can get a 2% discount if we pay for it within the first 15 days. And we're not concerned with what the cost of the merchandise sold was. That's relates to the seller. So we're just concerned with the first piece of information here. Let's take a look at what the solution looks like for this problem. Okay, so you can see here we purchased inventory and we have an accounts payable, $72,000. Later on, when we actually make the payment, if we make it within the discount period, we actually will not have to pay this full amount. But if we waited and didn't pay it early enough, then perhaps we would. On the second here, it says Sky Company paid the freight of $3,000 for delivery of merchandise sold to Big Company on May 1st. Okay, because it's FOB destination, that means that the seller typically pays for those charges, and thus there's no entry needed for us as the buyer. However, we are going to need to make an entry for what takes place on the 5th of May. Okay, so we're purchasing $48,500 more dollars, except for this time the terms are FOB shipping point. There's no discount offered, but the net is due at the end of the month. Once again, as the buyer, we do not care what the cost of the merchandise was to the person that's actually selling it to us. So you're going to see here in a second, we're going to increase our inventory and we are going to increase our accounts payable. This is what the journal entry would look like. On the 6th, we're going to return $12,000 of merchandise that was purchased on account on the 1st of May back to Sky Company. Once again, the cost information was only relative when we were the seller, and this now we're pretending to be the buyer, so we can disregard that piece. Okay, so notice, remember when we were the seller, when there was a return, we used the returns and allowances account. However, we're not going to worry about that when we're dealing with when we're the buyer. We're simply going to credit the inventory account. Remember, with the perpetual system that we're using here, we need to have a constant idea or value for our inventory. And so in this case, we're actually returning the inventory, so we're going to go on and credit that to reduce it, and we're going to reduce our accounts payable with a debit. Okay, now we're going to pay freight on the 9th of $1,800 on the May 5th purchase from Sky Company. Now when we were the seller, this didn't really impact us, and we didn't have to make a journal entry for it, but we're going to actually need to go on and make one in this case. And once again, the cost that we include in inventory, not only does it include the cost of the inventory, but also the cost that it takes to acquire it, right? So the shipping charge here, we're going to see we're not going to have a shipping expense or delivery expense. In this case, we did when we were actually the company selling it, but in this example here, instead of we actually paid it, so we're going to need to credit cash. But instead of debiting an expense, we're going to add that as part of our inventory. So we're going to go on and debit the inventory. Let's take a look at the journal entry. Here you go. On the 15th, we're going to make another purchase of $64,000 of inventory. Terms are FOB shipping point. That means that it's going to belong to us at the point in time that we actually ship it, not when it's delivered. Terms are 110 net 30, meaning 1% discount if we pay it within the first 10 days. Okay, and let's see here. Sky Company paid the freight of $25,000, which is added to the invoice. They went on and paid this, but it was something that was an expense of us as the buyer, so we're going to have to reimburse them for that. Let's take a look at what the entry looks like. Once again, we can disregard this as the buyer. We're concerned about this if we're the seller, the cost of the merchandise sold. Okay, so we bought 64 grand in inventory and had $2,500 in shipping costs that they paid for us. So we owe them $66,500. We're going to include the delivery expense, and because it's part of the cost of getting it delivered to us here in inventory, and we're also going to have to increase our accounts payable by the same amount, $66,500. Okay, we're going to actually pay for the May 1st purchase right now, reduced by the discount and the return on May 6th. Okay, so we returned $12,000 of merchandise on May 6th, and we're going to get us a 2% discount by paying this within the 15-day period. Let's take a look at what interest should look like. Okay, remember we started out with $72,000. We returned $12,000, so that leaves us with $60,000. Okay, we got a 2% discount for paying it within the discount period. 60,000 times 2% gives us 1,200. So the original amount reduced by that discount leaves us with only $58,800 that we actually need to pay. On the 16th here, we're going to make a payment for the May 1st purchase. Oops, I'm sorry, we're actually on the 25th now, aren't we? We're going to make the payment for the May 15th purchase less the discount. Okay, so we made here on the 15th a $64,000 purchase. Okay, and we're going to pay it within the discount period, and that's going to give us a it's going to give us a 1% discount. Let's take a look at what the journal entry will look like. Okay, guys, so remember it was a $64,000 purchase. We got a 1% discount. Okay, so we originally owed them $66,500, right? But this $66,500 is actually comprised of $64,000 plus the $2,500 in shipping. We don't use the shipping when we make the calculation of the discount. The discount is on the price of the inventory. It was $64,000. We reduced that by the $640,000. So when we look at the total amount here that we owe them for delivery expense and for the inventory, would reduce it by the amount of the discount here, and we're looking at an amount that we need to pay of $65,860. Notice we don't use a discount account here for the merchandise, and instead we use a merchandise inventory account when we're calculating these discounts, and that's because we need to record the inventory at the cost that it took us to acquire it, and that means delivery expense and what we actually paid for it. And at any time using the perpetual system, we need to have a current, up-to-date value of what our inventory should be. So we're actually going to use this inventory account. So these credits here are reducing the inventory, right? So this discount means that, hey, it didn't cost us, well, in this example, it didn't cost us $60,000, right? It really only cost us $58,800. And by making this credit to the inventory account, it'll make the math work out. And lastly, we're going to make a payment here for the purchase on May 5th. Okay? $48,500 purchase. There's no discount offered to us here. Let's take a look at the proper journal entry. Okay, guys, you can see here, we're just, and this is a pretty easy one here at the very end. We're just simply making a payment to Sky Company, $48,500. Okay, it's as easy as that. Thanks for watching the video. Please let me know if you have any questions at all. I'm here to help, and I want you to succeed.